Hi, I'm Jeff Spolstra with Summit Mortgage, and this is Mortgage Points. In this video, I'm going to talk about a favorite topic among borrowers, and that is mortgage insurance. What is mortgage insurance and why do I need it? All right, let's go to the what part first. Mortgage insurance is a insurance protection for a lender. It doesn't do a buyer any good, doesn't help in the buyer side or whatnot. It is strictly to protect a lender. Now, consider this. You're buying a home and a lender is giving you hundreds of thousands, if not millions of dollars to do so, and you're promising to pay it back. Now, you may have every intention of paying it back, but let's say something happens. You lose your job unexpectedly, or you become disabled and can't work, and suddenly now you can't make the mortgage payments. Well, that's called a default situation. If you don't make your mortgage payments, you are in default on your mortgage. And if there's no way to rectify the situation and try to get things back whole, then the lender, the mortgagee lender, is their only recourse is to take possession of your home and sell it. And their risk is if they have to do that, maybe they won't make enough on that sale to pay them back for the outstanding balance of your mortgage and all the costs they've incurred in dealing with the default, trying to sell it, blah, 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 right? Mortgage insurance exists to assure that a lender will come out whole, meaning they will get their money back that's owed them or due to them if you default and they end up having to sell the property. That's what mortgage insurance is for. Now, why does it exist? That's it. Do I always have to have it? No. If you are making a 20% or greater down payment, you typically don't have to pay mortgage insurance because that leaves enough equity room that in almost all cases, if you go into default and the lender has to sell the property, there's enough equity in there that they'll probably come out whole. So they won't be needing insurance. It's at the less than that case where they want to see mortgage insurance. And it's a graduated thing. It's going to be more costly if you're doing 5% down payment than if you're doing a 19% down payment because there's more risk that the lender won't come out whole if there's a problem in the end. Now, how do we deal with mortgage insurance? Well, typically most people understand or see it as a monthly payment, monthly addition to their monthly payment on their mortgage statement. That doesn't have to be that way. You can pay for it a lot of times upfront with a one-time lump sum in part of your closing costs and then not ever see it again. Or in some cases, we can split the two. You can do some of it upfront to lower the amount that you have to pay on a monthly basis. So things can be a little flexible in how you pay for it. But if you're doing less than 20%, there are some loans that will let you go to a 10% down payment without it. But if you're not doing a full 20%, you're probably going to look at mortgage insurance. Now, you've heard the terms mortgage insurance, PMI. What's the difference? The difference is kind of subtle. PMI stands for private mortgage insurance. That's mortgage insurance that's provided by an outside insurance company, a third party. MI, or mortgage insurance, or qualified mortgage insurance premium, MIP, is typically for government-backed loans like FHA. They have a different mortgage insurance structure. FHA in particular, regardless of how much money you put down, you're going to be paying mortgage insurance along with an upfront lump sum in your closing costs. Whereas for a conventional typical mortgage, again, you're doing 21%, you won't need mortgage insurance, or you can arrange how you want to do it instead of a monthly payment. So those are the fundamental differences. Now, can you get rid of mortgage insurance? Yes and no. On a FHA style loan, if you're not making a 20% down payment, you're going to have mortgage insurance for life, for as long as you have that mortgage. There's just no getting rid of it. So if you're doing a minimum 3.5% down payment on an FHA mortgage, you're going to be paying mortgage insurance for the life of that loan as long as you have it. You can refinance later to a different loan and get rid of it, but as long as you keep that loan, you're going to have it. Conventional mortgage, typically when the remaining balance of your mortgage is 20% or less of your original purchase price, then mortgage insurance can be made to go away. At 20%, you'll have to ask the lender to remove it. At 78%, they have to do it automatically. Now, you can petition in advance, right? If you think your property has appreciated to the point where your unpaid balance is less than 80% of the present value, then you can pay to have that value determined by a real appraiser, and then petition to the lender to say, hey, I want to remove my mortgage insurance. You can't do that right away. You may have to wait and make a couple years of payments first. It just depends on the type of mortgage, but you can get rid of mortgage insurance on a conventional loan for sure without having to refinance. So that's mortgage insurance, everybody's favorite thing. And if you have any questions, you know how to reach me. I'm Jeff at Summit Mortgage, and this has been Mortgage Points.